Tom Lee thinks that we crash in 2026.
What markets do in the first week or so give us a hint for how markets are shaping up for the year. Our base case was a rally, maybe to start the year, and then a big correction. I think there'll be a point this year where it's going to feel like a bear market.
Yes, all about that here in this video.
Welcome to the game, I'm the wolf of Dubai.
If you don't know who I am, my name is Mr. Early Investor Danny, and I'm investing early in Tesla, for example, in Nvidia, Robinhood, Palantir, and now also in BitMine. My subscribers bought houses and apartments. So if you're interested in free content about stocks that can absolutely explode, this is your channel. And I have also my personal group where we trade for you. A hand-picked day trading team works the whole day for you, watch the market, and sends you all the buying and selling into your portfolio, all done for you in your interactive brokers portfolio. We work with the biggest broker in the world, so we try to make between 8 to 15% growth every month in your portfolio. If this is something that is interesting for you, then schedule a call with me, because your $10,000 can grow to $58,000 compounded over a year, and then in the second year even to over 6 figures. And then we want to have you at one day the $1 million obviously on your account. Of this interesting, schedule a call. We have raising our joining fee every month, so make sure to do that before, and you will have the call with me. So very, very interesting as well. If we can help you, or it's nothing for you, then we can guide you to the right direction. Now, Tom Lee just came out and he said that he sees a 10-15% drawdown in 2026. This means for us crypto and very volatile assets like BitMine, a huge crash. What this means, and let's have a look first in the video.
He's also a CNBC contributor, and it is great to have you on in this early part of the year. Welcome.
Great to see you, Scott.
Market's off to a pretty good start, which was not necessarily unexpected by you.
I didn't have any expectations, but it's always a good sign to be strong out of the gate, as you know, because what markets do in the first week or so give us a hint for how markets are shaping up for the year. Our base case was a rally, maybe to start the year, and then a big correction, and then a rally at the end.
Big correction, if not a bear market.
I think
those are your words, not mine.
Yeah, I think there'll be a point this year where it's going to feel like a bear market.
Yeah. What about the way that the market looks as the year has begun? What do you make of it?
I think it's encouraging because we have some breadth, right? Energy materials are doing well. The Mag 7's catching a bit, and crypto's doing well. But healthcare's strong, financials, industrials are strong, and small caps. I mean, it's sort of a broad market.
I mean, almost want to say an everything rally. It's not like tech is doing terrible. It's just being overshadowed by some of these other moves. The equal weight S&P ETF is coming off a fresh record high of its own. That says everything about what's driven this market.
That's right. I think for investors and for institutional investors, breadth being good is always a good sign, actually.
Is it sustainable? Is this the way it's going to look for a little while?
Well, I do think there's a couple of sort of macro tailwinds that should help stocks. One is I do think that the economic clarity is better because the tariff disruption is more in the rearview mirror, even though we could get that overturned. But in general, tariffs aren't going up. They could be flat or down. And the second is the Fed is really turning into a tailwind because the Fed is leaning dovish. They're focused on the job market. QT is over. We have a new Fed coming. And so all of these are, in some ways, I think, and they're not fighting inflation anymore, a put for the equity market.
What happens if SCOTUS strikes down the tariffs? Is that a positive or negative for the market?
It's a source of confusion. It's going to depend on how they word their decision because, there may be refunds involved and claims. And of course, we know the White House will seek to re-implement the tariffs. But I think on balance, it means that we put a ceiling on the tariffs, that they aren't going to be higher, but there's a chance they're lower. That's a net positive.
I mean, there could be, I was going to use, you use the word confusion. I was going to use a little chaotic. I mean, it could be in the immediate aftermath of that and trying to figure out if, you have to start giving refunds to people, and then you wonder what the bond market may do. So there are a lot of things to consider as we could get this as early as potentially the end of the week.
That's right. Now, some investment firms have already been buying refund claims. They're offering to buy these claims from companies at 30 cents on the dollar. So in some ways, the economy is pricing in some of these refunds.
So one of the questions leaving 2025 was the valuation of the market. What price should you be willing to pay for what the expected earnings are? 22 times is where we were, which some had claimed to be rich. Barclays had a note out today which said they look reasonable. They say 22 times is not cheap by any stretch. In our view, current levels have not historically impeded returns, provided EPS growth remains positive. We do think that estimates are overly optimistic, yet we still expect the S&P 500 to print double-digit earnings growth this year. Do you have any doubt on the strength that earnings will come in at?
As you know, S&P earnings is a mix of all the 500 companies. But I think in 2026, earnings quality is going to be stronger because revenue growth is increasing and the rate of earnings growth is higher. So you have both top line improvement and margin expansion. That should support multiples to actually be higher.
So as you can see, he expects this in like the second half of the mid of 2026. Obviously, we need to take those kind of predictions with a grain of salt because it's impossible to perfectly time the market like that. Okay, so maybe we will have that, maybe not. It looks more or less like a copy of the last year, right? And think about it. When the new Fed chair that is more bullish for, let's say, risk on assets, more rate cuts, will come in May, and we know that already, and maybe Jerome Powell will kind of go out of the Fed first, then you can see that this is something quite interesting to have the first half of the year very bullish, and then the second year, maybe there will be always something like we had the Liberation Day last year, so there can be always something that can happen to the market that nobody sees from now, okay? So if it happens, then it should happen maybe towards the first quarter and then, push to the Fed in May or in the second half of the year. So let's see those predictions. Obviously, let's assume that at some point we see a 50 to 70 move in either direction for BitMine, not like from here minus 50%, but from here up 50% and from there down 70% or so on. So the stock market stays always volatile, specifically for BitMine. So let's see, and let me know what you think about the statement of Tom Lee, and I see you tomorrow for a brand new video because the grass is greener always on the other side.